So in early 2026, there was this massive geopolitical shock that hit the Strait of Hormuz, and global markets just bled out like 12.1% almost overnight.
Yeah, it was brutal.
Right, but the thing is, the real panic wasn't actually the crash itself. The true terror for investors was that the supposed safe assets, the gold, the bonds, consumer staples, they crashed right alongside the risky ones.
Exactly. The textbook rules of finance just completely evaporated in real time.
The very things built to protect you suddenly became the things dragging you down. Welcome to your custom deep dive. Today, our mission is to, well, basically decode that exact nightmare for you.
Because the foundational assumption of modern portfolio theory, right, is that certain asset classes will reliably zig when equities zag. And when that vanishes in a matter of days, that correlation breakdown turns a standard market correction into an absolute psychological nightmare.
Yeah, an absolute nightmare. So today we are stripping down Gregory Szkola's audiobook, The Leaking Pound. Specifically, we're honing in on chapter 12, which is called Turning Volatility into Opportunity. We're going to look at the anatomy of financial survival.
Which is so important.
It really is. We want to prove how you can stop fearing these terrifying, irrational market dips and actually start utilizing them as a structural advantage.
And we are moving entirely past abstract theory today. I mean, theory is totally useless when the VIX spikes and your entire portfolio is flashing red.
Oh, for sure.
So we are stress testing Skola's core strategy against that very real, very recent 2026 crisis. We need to see what happens when the financial bedrock actually fractures.
Right. So to understand how a portfolio survives a crash of that magnitude, we have to look at how the architecture is built, before the panic ever even sets in.
The foundation.
Exactly.
Yeah.
Szkola introduces this framework. He calls it the multi-pie portfolio, and it fundamentally shifts how you interact with your capital.
It really does.
Instead of treating your investments as this single amorphous blob where you just cross your fingers and hope the aggregate number goes up, you divide the portfolio into distinct sections, or pies, and you ruthlessly assign each one a very specific job.
It is an exercise in deliberate, unapologetic delegation. The structure demands three main pies. First, you have the growth pie.
Right.
This is where you're looking at your global equities, your emerging markets, and their singular mandate is to be the engine. They drive the returns, they compound the wealth over decades, but they are inherently highly volatile. That's just the cost of admission to real wealth generation.
Yeah, and then you offset that engine with the defensive pie. This is where your bonds, your consumer staples, and utilities live. The traditional assumption here is that demand for these sectors is relatively inelastic.
Right. People always need electricity and toothpaste.
Exactly. So their job is to cushion the blows when the growth engine inevitably stutters. And then finally, you have the crisis hedges. Gold, energy infrastructure, defense stocks. These are structurally designed to activate specifically when macroeconomic or geopolitical chaos hits.
Yeah, they're your emergency brake.
Reading through Skola's breakdown of this architecture, the image that kept flashing in my mind for you, the listener, was the management of a professional football team.
Oh, that's a great way to look at it.
Right. Because you cannot field a team of 11 elite strikers. Sure, your strikers, those are your growth assets. They're the ones scoring the goals, making the highlights, getting all the glory during a massive bull market.
Yeah, everyone loves the strikers.
But if you only field strikers, the second the economic momentum shifts and the opposing team gets the ball, you are going to get absolutely demolished.
The vulnerability of an over-optimized growth portfolio is just catastrophic when the environment changes. You desperately need defenders, your utilities and your staples, to slow down the opposing attack and just absorb the pressure.
And crucially, you absolutely need a goalie. That is your crisis hedge, your defense stocks, your commodities. Now, the psychological friction here is that your goalie might stand there for 89 minutes of the game doing absolutely nothing.
Literally just standing there.
Just standing there for years during a bull market. They are a mathematical drag on your overall returns. They aren't scoring points. But you still pay them, you still keep them on the field, because in that one chaotic minute when a penalty kick comes out of nowhere, their entire job is just to keep you in the game.
That visual perfectly captures the profound psychological shift the multi-pie system demands. By assigning specific mandates to different assets, it completely reframes market volatility.
It changes the whole mindset.
It really does. Volatility transitions from a random existential threat into a predictable mechanical tool. You stop looking at your entire portfolio as a single pass or fail grade,
Hmm.
and you start monitoring it as a dynamic system where different components are actively supposed to react differently to the exact same macroeconomic event.
Right. But holding on to that goalie when they aren't scoring takes massive psychological endurance. Which kind of brings us to the actual mechanics of funding this team month after month. Like, how do you maintain the discipline to keep putting money into the market when every financial news headline is screaming at you to liquidate?
Well, the human brain is just tragically miswired for modern investing. I mean, our evolutionary instinct is to flee from perceived danger. In the financial realm, a sudden drawdown in portfolio value triggers a literal fight or flight response.
Oh, absolutely. The panic is real.
The instinct to stop contributing, or worse, to actually sell at the bottom, is overwhelming for most people.
Right. And the math of dollar cost averaging, or DCA, relies on a really simple quirk of human psychology to combat that instinct. We hate seeing our cost basis, the average price we paid for an asset, sit higher than the current market value.
It hurts to look at.
It does. That delta is our unrealized loss. It feels like a physical weight. But Szkola argues that if you rigorously commit to a fixed monthly contribution, that unrealized loss becomes your greatest mathematical lever.
Yeah, the mechanics are beautifully counterintuitive here. Let's say you are managing a portfolio sitting at, say, 3,000 pounds, and you have ironclad discipline around a 1,000 pound monthly contribution.
Okay, setting the stage.
Right. Suddenly a geopolitical shock hits, and the market drops 5%.
Yeah.
Your portfolio is bleeding. The emotional response is to halt that next 1,000 pound contribution, because putting new capital into a falling market just feels like throwing cash into a furnace.
But the mechanized system removes that emotional veto. Because the market has dropped 5%, asset prices are objectively lower. Your fixed 1,000-pound contribution now acquires significantly more shares than it did the previous month.
Exactly. You get more for your money.
Or buying the exact same.
What this mechanized contribution system creates is an automatic, emotionless rebalancing engine. When asset prices are inflated during a bubble, your fixed 1,000 pounds naturally buys fewer units, which organically prevents you from overextending at the absolute top of the market.
It forces discipline.
Yes. And when prices collapse, it systematically forces you to accumulate more, perfectly positioning your capital for the eventual recovery. It mathematically converts the short-term agony of a drawdown into a long-term compounding advantage. Like the volatility itself becomes the fuel for your wealth generation.
The theory is flawless. Spreadsheets do not panic. The math of dragging down your cost basis works perfectly in a vacuum.
Yeah.
But we have to confront what happens when reality shatters the vacuum. We need to dissect how this exact multi-pie system handled the sheer terror of early 2026.
Yeah, and Skola's transparency here is what makes the analysis so incredibly valuable. He doesn't offer a sanitized retrospective of his wins. He provides the brutal, bleeding reality of his own portfolio during the geopolitical escalation around the Strait of Hormuz.
Right. For a bit of macroeconomic context for you, the Strait of Hormuz is a massive global choke point. Roughly 20% of the world's oil supply passes through that narrow waterway.
It's huge.
So when military tensions threaten to close it, you aren't just looking at a localized conflict. You are looking at an immediate, violent repricing of global energy costs, which instantly triggers supply chain panic and severe inflation fears across every single sector of the economy.
And the reaction across global equities was violent. The MSCI World Index, which is essentially the benchmark for the global stock market, plummeted 12.1% at the peak of the panic.
Wow.
But the real lesson of the 2026 crisis wasn't the equity drop. It was the catastrophic failure of the textbook hedges.
This is where the story gets incredibly uncomfortable. Because Skola's safe assets, the defenders and the goalie he had been paying for years to protect him, they got absolutely crushed right alongside his growth engine.
We have to look at the specific mechanics of these failures, because they destroy a lot of antiquated financial advice. First, the classic 60-40 portfolio split completely broke down.
The gold standard of investing advice.
Right. Historically, the assumption is that when equities fall, investors flee to the safety of government bonds, which drives bond prices up and stabilizes the portfolio.
The ultimate financial seesaw. One side goes down, the other goes up.
Until the seesaw snaps in half. In early 2026, stocks and bonds fell simultaneously.
Which is wild.
It is. The inflation fears triggered by the oil supply shock led the markets to price in massive, imminent interest rate hikes from central banks. When rate expectations spike, the yield curve aggressively reprices, and existing bond values plummet. The safety net vanished because the macroeconomic trigger affected both asset classes negatively.
And the carnage bled right into the defensive equities, too. Consumer staples, the massive global conglomerates making toothpaste, basic pharmaceuticals, packaged food, they fell aggressively as well. The traditional logic is that these companies are defensive because consumer demand is highly inelastic. People still brush their teeth during a geopolitical crisis.
Right, but inelastic demand is irrelevant if severe currency risk completely wipes out your operating margins. Which brings us to the most shocking failure of the entire crisis, gold.
Yeah, this part is crazy.
For millennia, gold has been the ultimate, unquestionable safe haven. When the world catches fire, capital flows into gold. Yet, during the peak of the 2026 panic, the price of gold suffered a significant drop.
Wait, okay, hold on. If his bonds failed due to inflation fears, his staples failed, and the ultimate historical hedge gold tanked right alongside the risky tech stocks, didn't the entire multi-pie system fail spectacularly? The goalie dove the wrong way, the defender scored an own goal. Why are we even analyzing this as a success story?
That pushback is completely justified. It feels like a total betrayal of the portfolio's mandate. But to understand why the system actually succeeded, we have to look past the surface-level price action. We have to examine the underlying causality of why those specific assets failed.
Okay, I'm listening.
The key to the entire 2026 anomaly, particularly the failure of gold, boils down to a single hidden variable, the U.S. dollar.
Ah, the global measuring stick.
Exactly. Global trade, sovereign debt, massive corporate liabilities. A staggering percentage of the global financial system is denominated in U.S. dollars. When a geopolitical shock of that magnitude hits, institutions worldwide realize they need to service that dollar-denominated debt, regardless of what the underlying global economy is doing.
So it basically creates a mad scramble for pure liquidity.
It triggers a massive short squeeze on the currency itself. Institutional investors, sovereign wealth funds, foreign corporations, they all hoard cash, specifically dollars. They sell whatever liquid assets they can, including gold, just to get their hands on U.S. currency. Because gold is priced globally in dollars, when the value of the dollar skyrockets, it takes fewer dollars to buy an ounce of gold. The measuring stick dramatically lengthens, so the asset being measured against it mathematically shrinks.
That makes so much sense.
Skola's gold holdings didn't fail as a store of value. The aggressive currency dynamics simply masked that value on paper.
And that exact same dollar wrecking ball demolished his consumer staples, didn't it? Think about a massive US-based conglomerate selling basic household goods in Europe or Japan. If the US dollar suddenly becomes overwhelmingly strong, the euros and yen they earn overseas are suddenly worth significantly less when they are converted back into dollars for their quarterly earnings reports.
Exactly.
The demand for their soap didn't drop, but their repatriated profits shrank. So institutional algorithms just dumped the stock.
Yeah, hedges didn't act as hedges because they were carrying hidden correlated exposure to currency risk that overshadowed their defensive characteristics.
So we come back to the core tension, though. If the system broke, how is this a win? This is where we hit the ugly, unglamorous truth about real-world diversification. Let's look at the final bleeding numbers of Skola's actual portfolio.
Let's hear them.
The global market, measured by the MSCI benchmark, lost 12.1%. But Skola's actual diversified portfolio only lost 6.4%. He actively avoided 5.7% in total market losses.
And in the realm of compounding mathematics, avoiding a 5.7% drawdown during a crisis is a monumental victory. The difference between a 12% loss and a 6% loss is not linear. It is an asymmetry of recovery.
Explain that a bit more.
Sure. So to recover from a 12.1% loss, a portfolio doesn't just need a 12% gain. It requires nearly a 14% gain just to get back to zero. But recovering from a 6.4% loss only requires about a 6.8% gain.
That's a huge difference.
By structurally capping the downside, he preserved significantly more capital to ride the wave back up when the panic subsided.
But wait, how did he cap the downside if the gold, the bonds, and the staples all sank?
Because while the traditional hedges failed, other highly specific components of his crisis pie activated with incredible aggression. Defense stocks, companies like BAE Systems and Lockheed Martin, they didn't just hold their value, they surged.
And that wasn't just a generic panic reaction either. That was a direct result of capital rotation. Institutional money fled from high beta tech stocks and looked for a safe harbor where forward earnings projections were actually expanding. The moment the Strait of Hormuz was threatened, global military budgets were instantly revised upwards by analysts.
Exactly. Capital ruthlessly seeks yield and certainty. The defense contractors offered both. Simultaneously, his energy infrastructure allocations at the midstream pipelines, they held up incredibly well because the sheer threat to global oil supplies created a massive premium on domestic energy logistics.
Right. And then there was the cash, the incredibly boring, entirely unloved cash and ultra short-term paper that just dragged on his returns for years. During the crisis, it didn't drop a single basis point. It just sat there, acting as a massive anchor against the volatility.
Yeah, and even the bond allocations that did drop due to rate fears, well, they still dropped significantly less than the 12.1% equity bloodbath.
It is the exact mechanics of a ship taking on water. Like, you hit an iceberg and one compartment is completely flooded. If that compartment is the entire hull of your ship, you sink to the bottom of the ocean.
Right, game over.
But if you have properly engineered watertight doors, the various uncorrelated pies in the portfolio, they contain the damage, the defense stocks surging, the energy pipelines holding firm, the cash acting as ballast, those were the watertight doors.
I love that.
Your ship is absolutely sitting lower in the water. I mean, you are down 6.4%. It's very uncomfortable. But you are not down 12%. You have not sunk. In the context of a global panic, being down 6% is not a failure. It is the absolute definition of survival.
This completely redefines what success looks like in asset management. Outperformance during a macroeconomic shock does not come from miraculously picking a single hero asset that shoots up 50% while the world burns. It comes entirely from the architecture.
The structure.
True diversification inherently means that there will always be a part of your portfolio that you hate. If everything in your portfolio is going up at the exact same time, you are not diversified. You are just highly correlated, which means when the tide turns, everything will crash at the exact same time.
Right. Diversification means accepting that when one basket gets absolutely crushed, another basket might get crushed slightly less. A third basket stays completely flat, and a fourth basket unexpectedly surges due to capital rotation. You blend all of those disparate reactions together, and your total portfolio loss is a fraction of the wider market panic.
And, recognizing that the system works beautifully because of its imperfections is actually incredibly liberating for an investor. You no longer have to burden yourself with trying to perfectly predict the future. You just have to commit to building a resilient structure capable of absorbing multiple different futures.
So how do you take these deeply uncomfortable, hard-won realities and apply them to your own multi-pie strategy for the next 20 years? Szkola's nightmare scenario actually distills down into a few vital organic shifts in how we manage capital.
Yes, let's go through them.
The overarching realization is that the structure of your portfolio matters infinitely more than your individual asset picks. When you break your capital down into these purposeful pies, you strip away the guesswork. You stop reacting to headlines and start managing a mechanical system.
And that mechanical discipline is what allows you to survive the failure of your own thesis. This whole debacle with gold fundamentally rewrites the rule book on how we view hedges.
How so?
Well, the instinct is to look at gold's failure in 2026, declare it a useless asset, and just liquidate it. But the discipline demands that you keep the goalie on the field. Gold failed during an inflation and currency shock, sure, but the next macroeconomic crisis will have an entirely different flavor. The asset that failed you today might be the exact mechanism that saves your portfolio during, say, a localized tech bubble tomorrow.
Oh, absolutely. And the 2026 crisis forces us to obsess over the measuring stick just as much as the assets themselves. The US dollar proved to be the ultimate hidden variable. It dictates the fate of global commodities and the earnings reports of international conglomerates. You simply cannot evaluate a defensive asset's potential without factoring in its underlying currency exposure.
Which leads to the final recalibration of expectations. Defensive does not mean bulletproof. Consumer staples fell, bonds fell, but they fell less than the high-growth engine. In a severe drawdown, falling less is the absolute bar for success.
Right, it's about relative performance.
Exactly. If you combine that structural defense with a long-term time horizon, the short-term damage is completely mitigated. A 6.4% drop is just a blip on a 20-year chart, provided you maintain your discipline and refuse to halt those monthly contributions.
So the mandate for you, the listener, is to basically stop exhausting yourself looking for a magical, impenetrable shield that deflects all financial damage, because it doesn't exist. The goal is to build an elite shock absorber. You are still going to feel the massive potholes in the global economy, but the structure ensures the axle doesn't snap.
And the application of this knowledge is the only thing that actually generates wealth.
Yeah.
For your own capital, this means trusting the architecture you've built in the cold light of day. It means forcing those regular monthly contributions through the system, especially when the headlines are terrifying, specifically to drag down your cost basis.
Yes, stay the course.
It means allowing time to do the heavy lifting over the next 2 decades without ever surrendering to the psychological urge to panic sell.
It takes market volatility, the very thing that keeps most people awake at night, and transforms it into the mechanical engine of your compounding wealth. As Szkola mapped out so clearly, violent drawdowns like the Hormuz shock are just one chaotic frame in a very long movie. Building this multi-pie, contribution-driven structure gives you the psychological endurance to stay in your seat and keep watching the movie without hiding behind the sofa.
It separates the amateur reaction from the professional process.
And that process is everything.
Mhm.
But as we wrap up this analysis, we want to leave you with one final, deeply provocative thought to chew on as you evaluate your own portfolio architecture.
This is a big one.
The data clearly showed that a fiercely strong U.S. dollar was the hidden variable that unexpectedly broke gold and consumer staples during the 2026 crisis. The dollar acted as the ultimate wrecking ball precisely because the world hoarded it in a panic. But what happens to this multi-pie strategy if the next macroeconomic shock doesn't just strengthen the global reserve currency, but actively breaks it? If the US dollar itself is the epicenter of the crisis, how do you hedge against the measuring stick itself collapsing?
I mean, that scenario would be the ultimate uncompromising test of true diversification.
Definitely something to seriously mull over the next time you look at your crisis allocations. Thank you for tuning in to your custom deep dive. Keep refining those shock absorbers, trust the mechanics over the panic, and we'll catch you next time.